Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Wendy's.
If you find our talks useful, please consider subscribe, like, and comment underneath because today we are looking at a stock that just, well, violently surged. Up 28.5% in a single day, hitting $9.
Yeah, causing serious whiplash across Wall Street, honestly.
No, totally. And, we've been analyzing a massive stack of financial data, analyst notes, retail sentiment trackers, basically to figure out the real question here. Is this just a meme stock trap or a legitimate structural turnaround?
Right, and before we pull apart all that data to answer the question, I should mention a really useful chart tool for investors and traders. Like if you want help reading trading charts more clearly, you can check out VIP Algos. The link is right below in the description.
Yeah, it's super handy.
It really is. VIP Algos is this TradingView indicator suite, and it shows you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even take profit and stop-loss planning areas.
Basically across all markets, right?
Exactly. Stocks, Forex, crypto, gold, indices, futures, you name it. But just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice. It doesn't place trades for you, and it guarantees no profits whatsoever.
Right, because trading involves risk.
Always. So always manage your risk, do your own research, and just a heads up, this is an affiliate link in the description, so we may earn a commission if you use it, but at no extra cost to you.
Okay, so let's unpack this and set the stage a bit. The sheer velocity of that June 24th move is, it's just staggering.
It's definitely not normal market behavior.
No, a 28% jump in a few hours, not normal. But what really caught my eye in the data is the broader wealth building context here, because the stock is currently trading at an estimated 43% discount to its intrinsic value.
That is a massive number.
Right, and sitting right in the middle of this is Nelson Peltz. Like, his firm, Tryon Fund Management, holds a massive 16% ownership stake.
Yeah, and that 16% ownership is really the anchor here. If you are, looking at your portfolio right now, wondering if you completely missed the boat when the stock was at $6, you really have to understand how Tryon operates.
Because Peltz isn't exactly a passive guy?
Oh, not at all. Nelson Peltz is not a passive investor. When an activist fund takes a controlling stake of that magnitude, they aren't just crossing their fingers and, hoping the market eventually recognizes the value.
Right, they force the issue.
Exactly. They get their hands dirty.
The data shows they push for board seats, force major strategic changes, and they're just ruthlessly focused on unlocking shareholder value. So you're basically betting on the activist holding the management team accountable.
That's the play, yeah.
But I got to push back on this discount narrative for a second, because a 43% discount usually exists for a very good reason. The market isn't stupid,
Right. Fair point.
So is this actually a reliable wealth-building opportunity, or is it just like a severely distressed asset, a falling knife?
Well, that is exactly the right question to ask. To determine if that 43% discount is a genuine opportunity or just a value trap, we have to look under the hood.
At the mechanics of the business model.
Exactly. We need to compare it to your typical failing meme stock, because we have to remember that this is actually a profitable cash-generating business.
Unlike a lot of those squeeze plays we see.
Right. And that stems from their franchise-heavy structure. Over 90% of their locations are franchised.
Which basically means corporate doesn't own the physical real estate for the most part. And they aren't the ones directly paying the hourly wages for the line cooks or managing the daily utilities.
Precisely. They operate essentially as an intellectual property and supply chain hub.
Ah, I see.
So they collect royalty fees based on the top-line revenue of those franchise stores, regardless of the store-level profit margins. That structurally supports really high cash conversion.
Because corporate isn't like sinking billions into constant physical renovations or battling direct labor cost inflation.
Exactly. It is a highly efficient, low capital intensity machine.
Okay, I understand the franchise model protects them from certain capital expenditures, but I was looking at these Q1 2026 filings, and I was honestly shocked.
The U.S. same restaurant sales.
Yes, they fell 7.8% year over year. That is a brutal drop in the fast food industry. A 43% discount starts to make a lot of sense when nearly 8% of your core sales just vanish.
You are absolutely right to focus on that 7.8% decline. It is severe, no doubt about it.
So what's driving it?
Well, if we look at the why behind that number, it's this nasty combination of intense consumer fatigue and just fierce competition. Consumers are aggressively pulling back on discretionary dining right now.
Everything's getting too expensive.
Right. And at the same time, competitors are fighting relentlessly to win back morning traffic with these crazy aggressive breakfast promotions.
And the forward estimates for the second quarter aren't exactly showing a massive rebound yet either.
No, they're not.
The data shows revenue is looking flat at roughly $559.6 million, with earnings per share expected to drop to 16 cents. So I have to stick to my guns here. If sales are plunging 8% and earnings are dropping, where is the structural upside?
It's hidden.
Like, why are we even discussing this as a turnaround?
Because of a massive operational shift happening right under the surface. This brings us to what we could call the hidden growth engine. When you dig into the store-by-store data, you see a completely bifurcated performance.
Okay, bifurcated how?
Well, corporate is currently rolling out a comprehensive operational overhaul called Project Fresh.
Project Fresh. Okay, so what does that actually mean on the ground? Because, corporate turnaround initiatives usually sound great in a boardroom, but then totally fail in the actual kitchen.
Yeah, that happens a lot. But Project Fresh is a complete reconstruction of how a store operates.
Like a remodel.
More than that, we're talking about fundamentally altering efficiency metrics, implementing aggressive new inventory management systems, and basically redesigning the workflow to maximize customer throughput.
Oh, okay. So it changes the physical capability of a restaurant to process orders quickly while minimizing food waste.
Exactly.
So they are increasing the absolute number of customers they can serve per hour while reducing the friction of taking those orders.
Precisely. And here's where it gets fascinating. The data shows that locations running the Project Fresh playbook are outperforming the rest of the legacy system by 310 basis points.
Wait, 310 basis points?
Yeah, 3.1%.
That's a massive outperformance spread in a fast food industry that literally fights for fractions of a percent.
It is night and day. And here is the crucial piece of the puzzle. Right now, only about 50% of the franchise system has fully adopted this new playbook.
Okay, wow. I actually love this setup. It's kind of like a major software update for a smartphone.
But that's a good way to look at it.
Right, like right now, only half of the phones on the network have downloaded the new operating system, and they are running lightning fast and super efficiently.
Yeah.
But the other half are still running the clunky, lagging old software. So if they can just get the other 50% of their franchisees to hit update, there's a massive runway for margin and traffic improvement built right into the existing physical footprint.
Exactly. They don't even need to build new stores to see a massive boost in revenue. That is a perfect analogy.
So the growth doesn't require massive real estate acquisitions.
No, it just requires operational execution within the stores they already have. And that functions as a structural moat. Competitors cannot easily replicate that 310 basis point bump without undertaking their own massive system-wide operational overhauls.
Which takes years.
Decades sometimes. Plus, they still maintain strong brand equity, right? Their focus on fresh, never frozen beef and their highly successful expansion into the breakfast market give them a very distinct value proposition against their biggest rivals.
Okay, so the blueprint clearly works, and the potential is sitting right there. It just needs to be scaled across the other 50% of stores, which brings up a critical question.
How do you force independent franchisees to completely overhaul their operations?
Exactly. Because that transition requires serious executive leadership.
It does, and the timeline here is crucial. In July 2026, we see the completed transition of the new Chief Financial Officer, Steve Cirulis.
Right, I saw his name pop up.
And what is vital here is that he is reuniting with the current CEO, Bob Wright.
I saw that in the notes, but why does that specific reunion matter to Wall Street? Like, why do they care so much?
Because this exact duo previously executed a highly successful, widely praised corporate turnaround at Potbelly.
Oh, wow. Okay, that makes sense.
Yeah, they have a proven, documented track record of taking a struggling food brand, instilling hardcore operational discipline, and driving shareholder value together. The market places a very high premium on a management team that has already proven they can execute under pressure.
But I guess someone listening might be thinking, hasn't the market already priced in this management team? Like, everyone knows they're in charge now. It's public knowledge.
Well, the announcement is public knowledge, but the actual execution is not. The market is waiting for proof.
Right, the numbers have to show it.
Exactly. And that anticipation makes August 7th, 2026, the ultimate proving ground. That is the date of their Q2 earnings report.
Okay, circle that on the calendar.
Yeah, it will be the first real, undeniable glimpse into how this new leadership dynamic is impacting the underlying financials.
And here's where it gets really interesting because we have to talk about the market mechanics happening in the background heading into that August 7th date, specifically the short interest.
Oh, it's huge.
We are looking at a massive 32 to 37% short interest on this stock right now.
That is an extraordinarily high number. Let's break down how that actually works for a second.
Sure.
Over a third of the tradable shares have been borrowed by institutional investors who then sold them into the market, betting that the price will fall further. But to close that bet, they eventually have to buy those shares back.
Right. So if August 7th rolls around and that Q2 report shows even a minor positive surprise, say, Project Fresh adoption is accelerating faster than expected or margins are ticking up, what happens to those short sellers?
They get completely trapped.
Yeah.
If the stock price starts rising on good news, those short sellers start losing money rapidly. To stop the bleeding, they are forced to buy shares to return the ones they borrowed.
And that forced buying creates a feedback loop.
Exactly. It drives the price even higher, which forces more short sellers to buy in a panic. That is the exact mechanism of a short squeeze.
And corporate is already trying to drive near-term traffic to juice those Q2 numbers, right? I saw they launched that summer Minions and Monsters menu collaboration specifically to boost top-line sales heading into this print.
Yes, they are pulling every lever they can find. And that anticipation around the August 7th earnings isn't just theoretical.
Yeah.
We are already seeing traders place massive bets in real time. Just look at the volume explosion on the charts.
Let's dig into that, actually, because the technical structure over the last few days has been wild. On June 23rd, the stock hit $6.07.
Yeah.
That was the lowest level in several years, happening on the exact same day the CFO transition was officially finalized.
That $6.07 level represents what we call a capitulation low.
Right. And for anyone unfamiliar, a capitulation low is that exact moment of maximum pain where the last exhausted seller finally throws in the towel and liquidates their position at a massive loss, which basically creates a bottom.
Yes. It creates a heavily oversold condition where there simply aren't any more sellers left to push the price down.
Right.
And the very next day, June 24th, the stock violently reversed and surged to $9. But the price action isn't even the most important part. The volume tells the real story. Over 24 million shares traded hands in a single session.
And the normal daily average is only about 8 million shares.
Exactly. A 3x explosion in volume. Reclaiming multi-month resistance levels on triple the normal volume in a single day is a psychologically significant regime change.
It's massive.
It indicates a massive shift from relentless selling to aggressive dip buying.
Which naturally brings us back to what you mentioned earlier about VIP algos. When you have a stock swinging from $6 to $9 in a matter of hours on triple volume, the volatility is just blinding.
It's so hard to read.
Right, so having a tool that visually maps out clear support and resistance zones is crucial so you aren't just trading blindly on emotion. But I always remind people, charts show probabilities, they never show guarantees.
Absolutely. The technicals show us where the battle lines are drawn and where the momentum is shifting, but it doesn't guarantee who ultimately wins the war.
Right, and technical breakouts of this magnitude, moving 24 million shares, they don't just happen by accident. Someone is aggressively hitting the buy button.
Yeah, absolutely.
So let's dissect exactly who is doing the buying here, because the sentiment data shows a fascinating divide between everyday retail traders and Wall Street institutions.
It really is a massive tug-of-war. On the retail side, it is an absolute frenzy right now. On the day of that breakout, the stock became the #1 trending ticker on StockTwits and the second most mentioned stock on Wall Street Bets.
Wow.
We saw retail investors buy a net $2.3 million worth of shares in just the first 30 minutes of regular trading.
Okay, so the retail momentum crowd immediately latched onto the short squeeze potential. But what are the institutional analysts saying?
Well, they are much more grounded, but also deeply divided. For example, Argus Research issued a buy rating with a $12 price target.
$12?
Yeah.
I mean, from the pre-rally base of around $6.70, that implies roughly 75% upside. That is a massive institutional vote of confidence.
It really is. But if you look at the broader consensus of 24 major analysts, they actually sit at a hold rating with an average target of 7.95 cents.
Interesting.
So the institutional crowd is essentially saying, we need to wait and see if the August 7th fundamentals actually prove this turnaround is real. While the retail crowd is saying, we're going to force a short squeeze today.
And driving a lot of that retail excitement is the massive, unconfirmed take-private rumor circulating right now.
Oh, yes. The rumor.
Let's examine that, because it radically changes the risk profile of this entire discussion.
It really does. There are widespread reports indicating that Trine Fund Management, Nelson Peltz's firm, have actively explored taking the company private entirely.
Wow.
They have reportedly sought financing support from potential co-investors in the Middle East to basically buy out all the public shares.
But why would Trine want to take it private instead of just fixing it on the public market?
Because fixing a massive franchise system like Project Fresh requires operational discipline that sometimes causes short-term earnings to fluctuate. And public markets punish short-term earnings drops relentlessly.
Right. Wall Street has no patience.
None. Taking the company private allows them to execute the turnaround away from the glaring scrutiny of quarterly earnings reports.
Oh, that makes sense.
And given Trine's existing 16% stake and the fact that the stock is trading at a depressed valuation compared to historical highs, a take-private transaction would likely require them to offer a meaningful premium to the current share price to convince other shareholders to sell.
Which represents significant immediate upside for anyone holding the stock.
Exactly.
Okay. I have to step in with a heavy dose of reality here, though. I want to caution everyone listening. Do not buy a stock purely on unconfirmed buyout rumors. It is incredibly dangerous.
So dangerous.
I've seen this play out time and time again. These deals fall apart in the boardroom, or the financing dries up at the last minute, and the moment the rumor fades, the stock price crashes right back down to its fundamental value.
That is a vital point. You cannot build your investment thesis purely on a rumor. It is an optionality, a potential bonus, but it cannot be the core reason you allocate capital.
Exactly. Which means we need to bring this analysis back down to earth and look at the actual risks. Let's map out what happens if this turnaround thesis completely falls apart.
Okay, well, the single biggest execution risk right now is the math surrounding their 2026 guidance.
The guidance, right?
To hit their stated full-year financial targets, the company mathematically requires a sharp acceleration in sales during the second half of the year.
And as we discussed, Q1 was down nearly 8%, and Q2 looks completely flat.
Right. That second half acceleration is simply not visible in the underlying data yet. It requires a massive leap of faith from investors.
A huge leap.
If that August 7th earnings report comes out and confirms continued deterioration instead of stabilization, the entire narrative breaks.
And if the narrative breaks, that short squeeze dynamic we discussed, it violently reverses into a massive sell-off.
Exactly.
This brings up a direct comparison. I've seen some of the retail traders citing online, actually. The Beyond Meat squeeze back in October 2025.
Oh, yes. That is a perfect structural comparison for the dangers here.
Yeah. We saw Beyond Meat rapidly surge by triple digits purely on squeeze momentum. Everyone thought it was going straight up indefinitely. But because the underlying business fundamentals, like the actual sales and profit margins, they didn't support that inflated valuation, gravity took over. The stock plunged right back down, trapping thousands of retail investors who bought at the absolute top.
That is brutal.
Momentum can inflate a stock price beyond logic, but if the earnings aren't there to back it up, the market always corrects itself.
Exactly. Now, the key difference, the reason the situation isn't identical to Beyond Meat is that here we are dealing with a fundamentally profitable cash-flowing franchise. They aren't burning cash just to survive.
Right, that's fair.
But your core point remains entirely valid. If you buy at the peak of a speculative retail-driven squeeze, you can still suffer massive portfolio losses if the corporate execution fails.
So, putting everything on the table. We've analyzed the 43% discount, the history of Nelson Peltz, the 310 basis point bump from the Project Fresh growth engine, the short squeeze mechanics, and the very real execution risks if Q3 sales don't accelerate.
It's a lot to weigh.
It is. So based on all of this data, what is the final verdict?
Based on the structural setup and the catalysts ahead, we are delivering a bullish score of 7 out of 10.
A solid 7. So how should an investor practically approach that score?
Well, the optimal short-term view is treating this as a swing trade leading into that August 7th earnings report, so roughly a 4 to 6 week horizon.
Right.
You're essentially utilizing that 32 to 37% short interest to capture a potential upside squeeze if management delivers even a slightly positive surprise on the Project Fresh rollout.
Okay, and what about the longer-term wealth-building view?
The long-term view rests entirely on fundamental execution. It's about realizing that 43% discount to intrinsic value by successfully forcing the remaining 50% of stores to adopt the new operational playbook.
Right.
And of course, monitoring that take-private optionality with Trine Fund.
But it must be explicitly stated, This is a setup for investors with a much higher risk tolerance who can stomach extreme price volatility.
Absolutely.
And as always, this analysis is absolutely not financial advice. We are not telling you to buy, sell, or hold this stock. Definitely not. I do want to leave you with a broader, kind of provocative thought to chew on today, though.
Oh, I like these.
Think about this. If activist investors backed by massive private capital successfully step in and take cash-rich, franchised legacy brands private at these depressed valuations, what does that mean for the future of the publicly traded market?
That is a great question.
Right, like if all the great turnaround stories get scooped up by private equity before the recovery actually happens, will everyday retail investors eventually lose access to these wealth-building opportunities entirely? It is definitely something to think about as you watch this play out.
For sure.
And speaking of giving yourself an edge in the markets, if you want a cleaner way to read trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
It's really helpful.
It can help make charts way easier to scan, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk.
Very true.
And again, this is an affiliate link, so we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.